You're watching Bloomberg Quint. We got two big announcements on Friday before we went in for the long weekend. One was a shocker of a GDP number of 5%, and the other, amidst that, perhaps in some ways to take away some of the negativity generated by that GDP number, was a mega PSU bank merger. We've got 10 banks being merged into 4. How does it help? Which banks are better placed? Joining us to answer some and all of those questions is Suresh Ganapathy of Macquarie. Suresh, very good morning to you. Thanks so much for taking the time to speak to us. I'm going to start by asking you for your impression on the announcement. I think we had all talked about the fact that there could be more, but, bunched up 10 banks being merged into 4. What was your initial thought?
Well, it's definitely a step in the right direction because the government just doesn't have any bandwidth to run so many public sector banks in the country. Finding the right kind of CEO or CFO or top management personnel to run some of these banks is proving to be an Herculean task. So it makes it easier for the government to manage if you have, say, about 7-8 banks in the country, public sector banks, rather than having 20 of them. But the real challenge, Ira, is that just merely merging 2-3 weak banks into one large bank is just creating another large weak bank. A whole lot of structural reforms needs to be done to make these banks a bit more protective and so that the taxpayers' money is not burnt away by continuously infusing capital in them.
Suresh, when you looked at the combinations, was it clear to you what they are going after? Because, when I looked at them, it didn't look like there was a clear theme of either creating strong regional lenders. In some cases, that was, seemed to be the objective, like in the Canara case. In others, it seemed to be driven by just size at a national level. Is there a theme there?
I mean, to be honest, it's very difficult to find a theme because all these guys are so very homogeneous. What they have only done is that at least they've ensured that all of them are on similar technological platforms when they had to merge with each other. I don't think so there is any concept of having any kind of regional presence. For example, why have two really horrible banks like Bank of Maharashtra and Punjab and Sindh Bank left alone? Because these two banks have no reason to be independent on their own. So I really don't think there has been any particular theme behind this merger. The only logic here is we'll have to bring down the number of banks to a few and try to somehow manage them, as simple as that. I don't think you should go waste your time trying to find a theme behind these mergers.
Okay. Does one set now post-merger numbers, does one look better than the other? I think all of them on a capital adequacy basis actually will be okay, given that there's additional capital being provided.
Yeah, so the CET1, we just did a rough analysis that post amalgamation and of course post the capital infusion announced in some of these banks by the government, the average CET1 for these banks turns out to be about 10.3, 10.4%. So that's a reasonable amount of CET1 that one should look at. But then the real problem here, Ira, is that their ability to lend is severely constrained because of the management bandwidth being totally used in the entire merger and integration process. Now that's going to be a very complex process. Look at what happened with Bank of Baroda also. The MD of BCG or the chairman of BCG was very clearly telling us that the decision making comes to a complete halt. What actually also happens is that from our sources, what we have here heard is the smaller banks, the decision making completely goes for a toss because they really push up all the decision making to the anchor bank because they say they don't want to take any decision when they're eventually going to be merged with the anchor bank, and the merger process itself is going to take a whole amount of time. So what happens here is that you now have to some extent some amount of capital to lend, but your ability to lend is severely constrained. So credit growth will still be a challenge for the economy despite this merger and capital infusion.
And also, since you mentioned the experience of Bank of Baroda, from a shareholder perspective, at least a minority shareholder perspective as well, there's no sign of value being generated even a year after the merger, right?
Absolutely not. I mean, there's no value. In fact, Bank of Baroda was cheap at 0.7 times, and after the merger, it went to 0.5 times. It can even go to 0.4 or 0.3. So, this is a total valuation trap that you're getting into. No way you should buy these banks just because they're very cheap. Remember that for the next 12 months, your entire operations are going to get severely affected. Why buy a bank when there is so much of mess in it? There will be trade union issues. There will be protests. The management is going to face a whole lot of problems. I don't think there is absolutely anything in the minority shareholders, for the minority shareholders to get into any of these banks.
Suresh, there was an attempt to say that these mergers are coming with some structural reforms, governance reforms, but I see from your note that you're not particularly enthused by any of what was announced.
Yeah, I mean, look, Ira, what I have been always saying that these public sector banks remain conduits for any kind of government's vested interest or agenda, and that always remains, right? So, on one hand, the finance ministry gave reams of pages of presentation talking about, how they would like to make the board independent and bring in more governance reforms. And the other hand, you have every now and then the finance ministry coming and saying that, we want the public sector banks to cut interest rates. Please launch market-linked or repo rate-linked products to pass on the monetary policy. The problem here is that you are still directing banks what needs to be done, and that is not independence. That's a total level of interference that you're trying to carry out, right? So I don't think merely changing a couple of directors on the board really makes for a big structural change. Really, it's a matter of intent, to be honest, and I don't think that clearly comes out. At least in any of these latest presentations.
Okay, Suresh, a couple of other questions. So one thing that everyone was saying is, as you also mentioned, if the lending focus for these banks goes away or goes down a little bit, maybe there's scope for private banks to come in and take market share. But the timing for that is wrong, right? I mean, look at what's happening in the lending market, look at what's happening in the economy. So private banks will be as selective, if not more, than they have been in the past.
Yeah, that's true. I mean, just because the public sector banks are in a bad position doesn't necessarily mean that the private sector banks have to go ahead and take up all those credit. Few pockets of opportunities here and there could be there. Some of the public sector banks indeed have good clientele. There's a lot of consolidation era which is happening in terms of consortium lending. So earlier, one corporate used to borrow from 15 banks for whatever projects they wanted to do. Now, obviously, they're confining them to 3-4 banks. And clearly, there the private sector banks have an edge rather than giving some of the business to the public sector banks. So yes, some market share is up for grabs, but then even the private sector banks have to be a bit more cautious as to what comes their way with respect to the kind of exposures these PSU banks will be happy to let go of, right? So yeah, they have to exercise a reasonable amount of caution.
Suresh, unlinked to this, I noticed a recent note from you which had cut estimates for private sector banks generally. You want to talk us through what you're seeing in the banking system right now?
Yep. Yeah, so what's likely to happen, Ira, is obviously you saw the latest GDP print number, which is at 5%, way below the economist's expectations, and as per some estimates, it also talks about the fact that if you had used an earlier base, it would have been even 2.5%. Anyways, the point here is that there is economic slowdown, and economic slowdown is broad-based. Retail in India has actually got affected a bit. I'm not necessarily telling that there is going to be a big retail asset quality blow-up or so, but nevertheless, they have seen a historic low level of NPLs. That should actually start inching up a bit on the retail sector, and some element of pressure on growth will definitely be there on the retail sector. And apart from that, clearly some of the things that we are seeing with respect to the auto sales number, with respect to some of the corporate sector stress, specifically in the SME sector per se, that all will cause a problem for the overall economy, and private sector banks are a part of the economy, and given a choice, they will like to exercise caution over growth rather than over compromising growth and going for what I would say margins or anything else. So clearly, in my opinion, growth will definitely get affected. To that extent, we had to cut earnings estimates even for private sector banks.
So broadly, even at the system level, you would now expect credit growth to be what, sub 12% this year?
Yeah, clearly, it will be sub 12% this year.
All right, Suresh.
We'll be lucky if we even touch 10-11%. See, nominal GDP growth this quarter was 8%. Yeah, so I don't know. It's going to be pretty challenging, I would say. Yeah.
Okay, Suresh. We'll leave it at that. Always good to get clarity from you. That's Suresh Ganapathy of Macquarie giving us a sense of the mergers and what the banking sector looks like. Thanks for watching.